Did you know? One book transformed countless retail investors from amateurs into winners. The man behind this transformation is Burton Malkiel, a Princeton economics professor and seasoned Wall Street investment advisor. His book, A Random Walk Down Wall Street, first published in 1973 and now in its 12th edition, is hailed as the Bible of investing. Its most powerful idea? The harder you try to predict the market, the more predictable you become to it. Using 50 years of data, Malkiel reveals a gut-wrenching truth. For the average investor, the best strategy isn't beating the market, it's joining it. Core insight number 1. The market's short-term moves are a random walk. They can't be predicted. You might think those slick Wall Street fund managers are geniuses. Malkiel's data says otherwise. 85% of professional fund managers fail to beat a simple index fund over the long run. What does this mean? Those experts charging high fees are often outperformed by a robot-managed fund. Still believe in head and shoulders patterns and double bottoms? Malkiel states plainly that short-term price movements are like a random walk, as unpredictable as a drunkard's path. Can you guess which way a drunk will stumble next? Neither can you with stock prices. Those fancy technical indicators? It's like reading tea leaves. You think you see a pattern, but your brain is fooling you. Here's a harsher truth. If technical analysis really worked, those analysts would be rich. Would they really need to sell you courses? Core insight number 2. You are your own worst enemy. Recognize this. Buy price immediately drops. Sell price immediately soars. Sell a winner too early. Hold a loser for far too long. See others posting gains and FOMO in. Congratulations, you've been poisoned by the trio of greed, fear, and herd mentality. Malkiel found the average individual investor earns just 3% annually, while the market average is 10%. Why the huge gap? Everyone is buying high and selling low. You think you're rational, but your emotions are hijacking your decisions. This is why 90% of retail investors lose money. Core insight number 3. The best strategy is a low-cost, diversified, long-term index fund. Malkiel's most shocking advice? Do nothing. Just buy index funds and lie flat. It sounds passive, but this dumb method beats 99% of the smart investors. Why? An index fund buys all the top companies. You don't need to pick stocks, time the market, or analyze financial reports. You just trust a simple logic. If the economy grows, you make money. It's like riding an elevator. You don't need to know how it works. Just press the right button and it takes you to your destination. Core insight number 4. Time is the ultimate wealth builder. One of Malkiel's most stunning stats. $1 invested in the US stock market in 1900 would be worth $290 today. But here's what's even more shocking. If you missed the market's 90 best days, your profit would be 0. What does this prove? Almost all the market's gains happen in a tiny handful of days. Since you can never know when those days will come, the best strategy is to stay invested all the time. People who try to time the market are like people trying to catch lightning in a bottle, doomed to fail. Malkiel even provides a simple allocation formula, the 100 minus your age rule. Age 20, 80% stock funds plus 20% bond funds. Age 30, 70% stock funds plus 30% bond funds. Age 40, 60% stock funds plus 40% bond funds. Why? When you're young, you have time to weather volatility and seek higher returns. When you're older, stability becomes more important than growth. It's like driving. You can go fast when you're young, but you slow down as you age. Core insight number 5. Controlling your emotions and sticking to the plan is everything. Malkiel famously said, investing is not an intelligence test, it's an emotional IQ test. The people who make real money in the market aren't the smartest, they're the most disciplined. They control their emotions and stick to their strategy. Let's do the math. Suppose you start at age 25, investing $200 monthly in an index fund with a 10% average annual return. After 10 years, $38,000. After 20 years, $151,000. After 30 years, $452,000. After 40 years, $1,062,000. See, no stock picking, no starting a business, no lottery tickets. Just consistent investing can make you a millionaire. This is the magic of compound interest, what Einstein called the 8th wonder of the world. The principles are simple, so why can't most people do it? Human nature. When the market is up, you think it's too expensive and hesitate to buy. When it's down, you're scared it will fall further. You take small profits too quickly, but hold on to losses, doubting the entire strategy. This is why knowing is not enough. It's the same with investing. Easy to understand, hard to execute. If you want to be in the winning 1%, remember these 3 things. Admit you're not a stock-picking genius. Give up the fantasy of predicting the market. Trust in time. Commit to long-term investing. Control your emotions. Don't let market noise shake you. After reading this, you have 2 choices. Choice 1. Continue as before. Believe in technical analysis. Chase trends, and essentially hand your money over to others. Choice 2. Become a smart investor. Pick a solid index fund. Start investing regularly. And patiently wait for the power of compounding to work its magic. Remember, the best time to start was 10 years ago. The second best time is now. Don't wait. Don't hesitate. Malkiel's 50 years of data proves this works. Are you ready to begin your wealth-building journey? Let me know in the comments. Which path will you choose? Like, save, and share this to spread the secret that can change destinies.